Hello, everybody. I want to thank everybody for tuning in to episode 15. We're very proud of ourselves. We've been able to make episode 15. We've been making a lot of shorts. Uh, to get everything out the way, let's go ahead and read the message here. Before we begin, I want to make something clear. Everything discussed in this podcast represents my personal opinion and representation of the economic events and financial markets. Nothing in this episode should be considered investment advice, trading advice, or recommendations to buy or sell financial instruments. Markets are complex systems influenced by countless variables, and every investor has different financial situation, risk tolerance, and investment horizon. This podcast is meant for educational purposes and macroeconomic discussion and not financial advice. What we're going to do today, we're going to examine patterns, signals, and structural risks in the financial system. Because once we understand how the system works, you begin to see things others miss. I would like to announce that my firm is committed to another partnership. Right, we have another partnership. We had a partnership with a major CPA firm, ABGI. We're very proud of that. And this particular partnership is a financial institution, which is Rock Financial. And I was gracious enough to have a conversation with the vice president of the company, and we had a wonderful conversation. And he likes the direction my firm is going in, and he wanted to partner with me. So I think this is going to be a very good partnership for the future. Now, again, what we're going to be talking about is what we're going to be talking about. We're going to be talking about the three T's, like the three T's: the taxes, the tools, and the truth. In this particular case, we're going to be talking about the tools and the truth. Now, these are the different segments that we have in our episode. We have the AI sell off. We have that in section one, which is the Nasdaq's collapsing in South Korea craters and the semiconductor's dream to hit a wall. And then we have section two, which Oracle's confession was 13% of the workforce is gone. AI didn't just threaten jobs, it took them. Now, section three is the unified thesis. The market feared what companies are already executing, and the reckoning is now. Then we have the famous B-Swim report, economic dashboard. We haven't done that in about a month and a half. I've been very busy. I apologize for that, but we have a very comprehensive report that's going to go over the market. We're going to do another episode that's going to dive deeper into the market and talk about some of the things that might affect the market directly. Okay, and then next we have, of course, section five, which would be what you should do, right? The practical implications for business owners and investors and operators. Okay, we're in part one. This is the AI sell-off that we're going to be addressing in part one. The question we need to ask is, when will it recover? It's when will a rally be warranted now that we have this massive sell-off? Okay, so now we're going over we're taking a snapshot and looking at the stock market. Okay, this is covering from June 23rd to June 26th, 2026, of course. And what you see is South Korea's sector is leading the way, down by 10%, right? The Nasdaq is down by 2.21%. The S&P 500 dipped a negative 1.44%. And then the VIX, which, again, for those who don't know what the VIX is, the VIX measures volatility. So the VIX shot up by 12%, showing a volatility in the index, on the fear index. The fear index surged to 19.43%. Next, we're going to look at the root cause. What caused this dip in the market? We'll look at some of the things that happened. Was tech companies committed record capital to AI infrastructure and data centers and chips and compute networks. No clear timeline on the magnitude of the return on the investment, which is always a concern when you deal with companies like OpenAI and stuff like that. People are asking, they're saying, hey, your profits don't meet your projections, right? And it seems like this might be coming to roost a little bit. People are just saying it. Just everything doesn't add up. You're saying that you're gonna make these long-term investments, but your revenue, your ROI is not commiserate of these large investments that you're making over a long period of time. So that might be some of the things that are starting to become clear, coming into focus, right? So the new no clear timeline or magnitude of return on the investments. Bank of America note warned of up to 3% rate hike this year. Nvidia fell 4%. Micron dropped 14% on earnings. Oracle fell 5.5%, down 27% for the month. Analysts cite excessive froth and unsustainability rally. Now, next, what you have is a confession. This is part two, a confession by Oracle, right? Oracle's is basically saying that there is going to be a reduction in the workforce as a result of the deployment of AI. And we're going to explore that on part two. So, as you can see here in this snapshot, uh, 21,000 jobs have been eliminated as a result of the institution of AI, right? Uh, the workforce has been cut by 13%, and restructuring costs is $1.8 billion as a result of instituting this AI. So it's very compelling. These are compelling numbers that you see that the result of actually implementing AI in some of these corporations, in these tech companies. Again, the true question is the market is starting to panic. As you can see, as the AI ROI is not necessarily panning off as it relates to as it drives layoffs. The investors fear the cost, the labor costs, the long projected capital expenditures that AI is creating, and wondering if the ROI is going to be able to meet these large expectations that these AI companies are saying they have. Right? They want to spend billions and billions, on capital infrastructure, but they're not. The revenue is not meeting it out. So it just one hand is not washing the other, and investors are starting to realize that they're asking harder questions now as we're starting to see the sell off. They're saying, where is the money coming from, right? We don't see it now. We don't see the money coming now. So we don't know if you're going to be able to meet these capital expenditures. And again, this is what Michael Burry was talking about all the time, as he made a risky bet on Palantir, but this is what Warren Buffett and Michael Burry is talking about. And it looks like now it's starting to come to fruition. Okay, now we're gonna go over the B Swim report. Again, the B Swim report is my favorite. I made this report. I named it after a quote that Warren Buffett made. Basically, when what the B Swim report is representing the quote that Warren Buffett said, and it reads as follows. Again, for those who have never been on my podcast, it's it goes like this: only when the tides go out do you discover who's been swimming naked. So again, as liquidity starts to dry up in the private equity markets, you'll see a lot of things. You saw Silicon Bank, you saw FTX. You're starting to see people starting to have problems. No longer can you rob Peter to pay Paul anymore. It's harder to get loans. Hey, I'm down 50 million. I'll just borrow against it, right? I'll borrow against some equity that I have, but the banks are taking a harder look at the financials of some of these institutions and trying to see what they're using as collateral, right? And in some cases, they're changing the margin requirements on some of these loans. Okay, this is the executive overview of the VSWIM report. What we see is the credit card delinquencies are elevated. Auto loan delinquencies are at the highest consumer stress area. Commercial real estate there's refining pressures continues. Federal Reserve policy is restrictive as rate hikes are possible. A recession possibility is yellow, is elevated but not imminent, and corporate earnings for large cap is still outperforming. But again, it's outperforming. But the question we need to ask as we look at the Warren Buffett indicator is that a lot of these stocks are overvalued. Again, we have to look at that, right? And then you also have to look at the inside selling as we look at the market breadth report. As we look at the market breadth report, we see that 90% of all the stocks are still selling, right? It's just the Magnificent Seven and a lot of companies in the tech sector are basically holding up the whole stock market. It sounds incredible, but that's what's happening. Okay, we're going over the recession risk, right? And these are some of the indicators for a recession. Again, we're looking at a credit card defaults, which are rising. Auto defaults are at the highest stress level in a cycle. Office vacancies, the CRE is not recovering. PMI manufacturing is improving but fragile. Then the PMI services still holding the lone bright spot, and a consumer sentiment is recovering slowly from historical lows. And small business optimism is cautious and not confident. Next, we're going to go over on the B-Swim report is the credit stress. Okay, so first we have auto loans in terms of delinquencies. They're slowly going up. The accelerated default curve, consumers cannot sustain current auto debt under elevated rate conditions. So what we have is a lot of used cars are being repoed, right? So we got more used cars that are going into the market, right? That are being repossessed by the banks. In terms of commercial property, commercial real estate, we have delinquencies. What you have is Blackstone is actually walking away from real estate mortgages, right? Where they feel like they're upside down, right? They're saying, hey, if the building was worth 500,000 and then it has depreciated, dropped the value of the property has dropped to 200,000. They're saying, hey, we're just going to walk away, right? They're just going to sell it cheap and walk away from it because at that point they're upside down and they know they're not going to recoup. But what's interesting is firms like Blackstone, what they're doing is they're kind of shifting their investment. So they're taking away from commercial properties that they're upside down in, and they're investing in other properties where they see equity in it. So it's quite interesting. And then next we have mortgages, which you see. These are all in all three categories. You see the trend, and it's slowly going up. And this is a 3-month trend that you see. Next, we're going to talk about the liquidity trapdoor, institutional signals. So that the SOFR is yellow, reverse repo is yellow, cautionary. Treasury liquidity is cautionary. The credit default swap stress is green. Banking liquidity is yellow, cautionary. Institutional behavior scorecard. Commercial property sales are red. Distressed loan purchases are green. New opportunity funds are green. Office exposure is red. And that goes to what I spoke about with Blackstone. Industrial properties are green. Data centers are green. Logistic warehouse are green. Multifamily apartments are cautionary. And hospitality sector is cautionary. Okay, now we're talking about what does this episode mean to you? What can you garner from this episode that I'm making, right? So basically, as a business owner, you need to look at real estate, right? If you have real estate investments, you need to understand that if you're upside down, you need to restructure. You need to follow the way the herd is going. In terms of when you see Blackstone is, yes, the headlines are saying Blackstone is walking away from million dollar commercial properties. It's true. But the other side of the headlines that they're not talking about in the article is that all they're doing is restructuring their investments. What they're doing, they're taking their losses. They realize they're upside down, where a property might have initially been worth $500,000 or in the millions, and now that it's depressed and it's only worth 200,000. So they just walked away from the property, right? They knew they were upside down. The chances of them being recouping that value in the near future is slim to none. So they walked away from it. But what they did was they're reinvesting in other depressed real estate properties, right? So where they lost there, they figure they're going to win in the long term in terms of making these investments, right? So also what you have with investors, you need to keep your eye out for the AI sell-offs, right? You got to be mindful of that. At what point, people talk about it. Is the AI bubble going to pop, right? You need to uh, look at the capital investments that these AI companies are making, and basically understand that some of the investments they're making is kind of circular. I talked about this in one of my former podcasts, right? You have Anthropic investing in Google, and Google investing. It just goes all the way around. Google investing in Amazon. So some of this revenue is not coming outside of this economic pool, right? So at some point, investors are going to have to take a look at this and say, is this really true? Is this true revenue? Is this or something just encapsulated in this economic circle that all these AI and tech companies have? And then next, as a CFO, you need to restructure your market. You need to understand that you have a head count, right? And then you have to factor in the cost that automation is doing to your workforce, right? So that's something that you need to sit down and do some kind of report on that, and talk to the board of directors about that. Now for the final thoughts. I want to thank everybody for watching my episode. Again, this is episode 15. We have a lot of shorts out there. I think we've come a long way. Now we have about 100 videos out there, and we're getting a lot of good feedback. Please put a comment. I encourage you to put a comment. I like the banter back and forth, not necessarily argument, but just banter. I like to share ideas and opinions and stuff like that. And also, I have my website. I have my multimedia website, which is DarrenBushInspires.com. I'll be doing some public speaking pretty soon, too. I'm excited about that. Also, I have my company website, which is Taxman, www.taxman.today. The name of my company is Theogony Financial. We do tax preparation, tax planning, and bookkeeping. I also serve as a fractional CFO as well. So if you need any special projects or anything like that, just let me know. You can email me at DarrenBush@taxman.today. And that's just about it. We also have the message of, I always have a quote at the end. So machines feast, the markets bleed, and the data does not lie, right? So, and also the last quote is, but the ones who read it and act on it, that's where the advantage lives. So basically, you have to you got to read the tea leaves, right? You have to understand that you have to look at it and recognize whether the AI surge, which Warren Buffett with the Buffett indicator talked about, that a lot of these stocks are overvalued. So you have to ask yourself, is the capital investment that these AI tech companies making are realistic? Are these projections, or is the ROI projections for these tech companies realistic? Some people say no. Some people say no. Some day traders are saying, we don't care. We're just gonna ride it to the top. So you just got to make your decision. So you have a nice day, and I thank you for your support, and I look forward to episode 16.